Well, good morning everyone, and welcome to the latest series of webinars as part of our VIN Link membership offering. Today's topic, we're going to be talking about there's more than one way to buy property inside a self-managed super fund. Now this essentially stemmed out of a lot of debate, if you like, that's going on about the whole limited recourse borrowing arrangements, and whether they're sort of good, bad or indifferent for not only the self-managed supermarket but also...
The broadcast is now starting. All attendees are in listen-only mode.
Good morning everyone, and welcome to the next series of webinars offered under for the membership of VIN Link. This topic today is relating to there's more than one way to buy a property inside a self-managed super fund. This essentially stemmed from a lot of discussions that's been going on within the industry, talking about limited recourse borrowing arrangements specifically, and whether they're good, bad or indifferent to the not only the self-managed super industry, but also the super industry, the property industry, and that's more on the back of creating property bubbles or artificially increasing property prices, that sort of thing. So essentially we decided that it'd be worthwhile having a discussion about the different ways in which a fund can buy property, and not only focusing on the limited recourse arrangements that are available. So, to my reckoning, there are 9 ways in which a self-managed fund can acquire an interest in real property. Now, these are essentially broken into the 9 different types there. So, cash acquisition, in specie transfer, tenants in common, multiple members joining a fund, and I'll explain a little bit more about that one. The joint venture arrangements, borrowing structures, so limited recourse borrowing arrangements, via a non-geared unit trust, a limited recourse borrowing arrangement into a non-geared unit trust, and then finally an unrelated unit trust. So there's a fair bit there to go through, and I will touch on some of them more than others, because some of them are very simple, while others are a little bit more technical in the way that they work. So, without further ado, cash acquisition is obviously the easiest and most common, if you like. Traditionally, it's been the most common, certainly. So that's basically where a member and a spouse, they've got sufficient money inside their super fund, and they go out and acquire a property outright. Typically, this arrangement occurs when their members are sort of around the age 50 mark. Perhaps their children have left home, so they're empty nesters. They might sell their house to contribute money into super to acquire a growth asset in a more tax-effective environment, while they're not that far away from being able to access their super anyway. So it's the impediment, if you like, to locking into super isn't really there. However, this is typically meant that smaller properties are acquired because particularly these days, it's uncommon to see very large superannuation balances unless they were accumulated before 2007, which is obviously not that long ago, but I think we'll see larger balances inside super. So this method, while very relevant, I think will probably dwindle away to a certain extent as well, as trustees want to move into larger sort of properties. In specie transfer, so this is where someone owns a property, usually personally, and they wish to transfer the property into the self-managed super fund. Once again, that transfer, it's considered a contribution. So if the property is worth more than $450,000, then they may need a spouse. If the spouse is already on the title of the property, then that works perfectly. If the spouse wasn't, then technically you've got a stamp duty issue, because you're transferring into the name of the spouse, who then puts it into the super fund. There are other ways in which to, I suppose, alleviate some of that, and that can be done via a limited recourse borrowing arrangement. we arranged one a couple of years ago where a client did a partial in specie transfer, partial cash purchase and partial limited recourse borrowing arrangement to facilitate their business property being transferred into the super fund. So that was about 3-4 years ago now, while property prices were essentially at their lowest. So they were able to not pay capital gains tax in their own name, but obviously then have the upside inside their super fund, where the most they'll ever pay is 10% capital gains tax. To do this though, a market valuation must be obtained, and that's an independent valuation. I would also suggest that a proper valuation is obtained, not just a drive-by from a real estate agent. And also a rental valuation and lease agreement must be in place if you're using related parties to use the premises. So the example that I gave, where the business premises were put into the super fund and they're continuing to use that, then that's where it's important to make sure you have those things ticked off, because otherwise the regulator will say Section 109, being the arm's length test, and also Section 62 for sole purpose, haven't been met. So it's very important that that's the case. And also I shouldn't neglect there the non-arm's length income provisions as well under the Tax Act. They can also come into play if the property hasn't been transferred at the proper value, or if rent isn't paid at the correct value as well. So once again, that's a very valid strategy for some people. Tenants in common. Now this is where you essentially have multiple parties acquiring the property jointly. Now the biggest impediment to this method is that if you're acquiring residential property, then the super funds cannot acquire a greater interest in that property at a later point in time, assuming the parties are related. So by way of example, a self-managed super fund and one of the members of the fund acquires a residential property 50-50. Let's say that 5 years down the track, the super fund has built up more cash reserves and wants to acquire the balance of the property off the member. Unfortunately, that cannot occur because that is a related party transaction which is in breach of the SIS Act. If it was business real property, then that would be fine because there is an exclusion for business real property in these circumstances. Obviously, if one of the parties wants to exit the property, then it's very hard to actually sell a part interest in a direct property like that. And technically, you do have a tax partnership. So you're now in a situation where tax returns and financial statements should be prepared for this arrangement, and then the super fund uses those as part of its ongoing sort of valuation methodology and rental income splits and so on and so forth. And as I've put down the bottom there, a non-geared unit trust, which we'll touch on shortly, is a far better outcome to achieve exactly the same result. It's a little bit more expensive to set up initially, but the reality is that that's the only additional cost that you're likely to incur for a far more flexible outcome. One thing that shouldn't be discounted or forgotten about essentially is where members all join one super fund. I had a situation recently where two people already had existing self-managed funds, wanted to acquire a property, and we ran through a number of the options that we're talking about here today, and we couldn't really get one that sort of worked for what their needs were. So in the end, the best outcome was having the two members roll a portion of their member balance from their self-managed fund into a joint fund. So now, yes, they have two self-managed funds each. However, this fund here is only relates to the purchase of the property, and that then solves another little issue that I'll touch on a tick when I get to limited recourse borrowing arrangements, in that you can't, I believe, you can't actually have more than one super fund involved in limited recourse borrowing arrangement. Obviously this avoids that situation because the members are all in one fund. And you can have up to 4 members in a self-managed fund. As a quick refresh, the definition of 17A, which you're more than likely already familiar with, you can only have 4 members or less. All the members and trustees, all the members must be trustees and trustees must be members. No member of the fund is an employee unless they're related, and there can't be any remuneration paid to the trustees. So I suppose the thing I really wanted to highlight there was that no member of the fund is an employee. So you can't have the situation where say a staff member of mine wants to become a member of my super fund, because they're not a related party, so therefore they couldn't be part of the fund itself. So that's certainly something to consider as part of the arrangements, and I suppose options available to you that sort of just sit in your back pocket there as an option. Now, back in the day, joint ventures were essentially common, or certainly they were a lot more common than what they are now. I don't touch joint ventures with a barge pole and would never recommend clients going into them, for the simple fact that it's very hard in a superannuation environment to actually prove you have a legitimate and constructive joint venture. Now, back in, if memory serves me correctly, about 2004, there's a GST ruling that talks about what actually constitutes a joint venture arrangement, which goes through a lot of the detail as to what it means to have a JV. And then, as part of SMSF 2009-4, the tax office talks about joint venture arrangements within inside that. So essentially, a self-managed fund that contributes money under a contract towards the property purchase and which to acquire by a related party. The self-managed super fund is entitled to receive payments under the contract, and the amount of the payment is a portion of the proceeds, is basically what a JV is in their mind, and they consider that it's an investment in a related party, and therefore it's an in-house asset. So even though you may have the best of intentions to have a proper functioning joint venture arrangement, the tax office essentially deemed them to be a investment in a related entity, which is obviously not a very good outcome for the trustees of the fund when there are far, far better and easier options to do it, being the non-geared unit trust that we'll talk about shortly. And you'll notice that a lot of the options that were coming here, another way to get around it is via the non-geared unit trusts. Now, the borrowing arrangements. So limited recourse borrowing arrangements. Most people are probably pretty familiar with these, so I won't go into a huge amount of detail, but I certainly will, I suppose, spend sufficient time, I'd like to think. So as far as the borrowings, it must be structured in a particular way, and I'll put up the diagram that most of you have probably seen 400 times by now. The borrowing must be used for an acquirable asset, and that asset has to be held on trust. So the self-managed super fund has the beneficial ownership of the asset. However, the asset itself is held in a bare trust, is the word I'll use, for legal purposes. So the legal ownership is held inside that bare trust. And as part of the arrangement, the self-managed super fund has a right to acquire legal ownership of the asset by making one or more payments. Now, I suppose one thing that I should also just mention here is that there is a draft legislative instrument kicking around that essentially means, or I should say removes, the current obligation that once a property has been, or once the loan for a property has been paid out, that the the fund must transfer that property back excuse me, back into the super fund. The tax office have held that position since 2007 and have, I suppose, reiterated that on many occasions. Late last year they issued a draft legislative instrument that essentially means that that requirement will no longer exist. Now, it isn't passed as yet. It's out for consultation, I believe, until the end of this month. So it doesn't need to go through Parliament. It just needs to be essentially enacted upon by the tax office. So hopefully by March we will have some certainty on that, which is a good thing because there has been certain issues, particularly in Queensland, in some arrangements where the loan's been paid out in transferring that property or that asset back into the super fund. If we can keep it in the bare trust, then it just makes it a little bit easier. It's just one less thing you have to worry about. As I've mentioned there, only one self-managed super fund per property. And I know some will disagree with that because legally it may be possible to do. Certainly the banks would not lend on it, and the reason why I make that comment is that back in 2007 when these came out, there had to be an absolute entitlement for the super fund to acquire the property. Now, you can't have an absolute entitlement if there's more than one interest in the property. So that's essentially, I suppose, my position. And once again, the reason is that it's not like it's a death knell. There are other ways in which you can structure around it to avoid, having a potential issue play out when you don't need to. Now, obviously, any loan to the super fund has to be on a limited recourse basis. So what that essentially means is that the loan is limited to that asset. So no other asset inside the self-managed fund can be used or taken as collateral by the lender if there is a situation of default on the loan. So they only can get that one asset. And I'm sure, as we all know, what banks will just do is grab a personal bank guarantee for everyone involved in the transaction. And finally, I've just got down there SMSF 2012-1. This is quite a good paper put out by the tax office, which goes into a bit of detail about different types of limited recourse borrowing arrangements. It talks about the whole impair versus improvement, that sort of stuff. So it's well worth a read if you have a client looking to get into an arrangement, just so you can discuss it with the client and talk about the different scenarios and options that may or may not sort of play out. So this is the structure that, as I mentioned, you've all probably seen 400 times before. So the self-managed super fund obtains a loan from a bank or related party or both. I have situations where we have a bank loan and then we have a related party loan in there just to give them sufficient capital so they could actually meet the bank's requirements. And most banks are fine with that, so long as the related party loan doesn't have a registered interest on the title as a mortgagee. And the super fund acquires the beneficial interest of the property, while the legal title of the property is held by the bare trust. Now, what I've got there is just excuse me, a few of the names that I've seen over the years as to what bare trusts are called. Because I remember having a discussion with an auditor once who said that they just had training on these arrangements and that they couldn't approve the documents that we had provided them because it wasn't called, I think from memory they call it a custodian trust. And I duly pointed out to them the legislation doesn't actually specify a name, it just means that it can be called a number of different things. So the tax office used the term holding trust. Excuse me, from a legal sense it is more of a bare trust type arrangement, and the reason why it's a bare trust is essentially to look through. It's held on nominee for the super fund. Now I mentioned that it's a single acquirable asset. So what this means is that the super fund can only be used to acquire one asset. So a single asset. However, the ATO have, I suppose, been a little bit commercial about their interpretation of that. And once again, this is covered off in SMSF 2012-1. In that if you have a property where there is a legal or physical impediment to dividing the property, in other words, a physical impediment being a factory spread across 3 titles, if because of that physical or legal impediment you can't separate the asset, then it is treated or deemed to be one single asset. So what that means is you only need one single bare trust, one contract, all that sort of thing. If it is a multiple, if it can be separated, then you would need multiple bare trusts and multiple loans. I had one recently where it was a pharmacist who was buying a pharmacy property. It was actually on 2 titles. The property itself quite clearly sat across both, so I was very comfortable that it was a single acquirable asset. However, their lender, which happened to be the NAB, they insisted on either separate contracts for the 2 different lots, or actually having separate the separate lots listed onto the one contract. So they were happy with the one bare trust, but they just needed that detail for their own internal compliance. So that's where it's one of those situations that we've probably all faced before, where the legal requirements and the bank requirements can differ, and you have to be a bit flexible and work with those sort of scenarios. So I suppose extending that concept of a single acquirable asset a little bit further, multiple titles that cannot be disposed of separately, so they can also be considered a single acquirable asset. So even if you have a unit and a car park, even though they're quite separate, if they're on one title, then they're one asset. However, if you have a unit and car park on separate titles, they are very much separate assets, so which means that you would need 2 bare trusts, or you just pay cash for the for car park and you do the borrowing arrangement against the unit. So you can split it up like that. Now with farmland, same sort of thing. It's unusual to have one property that is 400 acres or hectares. What typically happens is there are a number of lots that make up a farm. Now, if a super fund is borrowing to acquire that farmland, typically there'll be multiple lots, so therefore it means multiple bare trust arrangements. Furnished apartments is a bit of a catch, that if a member or a trustee is buying a unit that has a furniture package associated with it, then that furniture package needs to actually be purchased out of cash or separately, rather than by using the loan arrangement, because you would actually need a separate bare trust for every piece of furniture, because every piece of furniture is essentially a single acquirable asset. So you can imagine setting up a bare trust, for the couch, one for the table, one for each chair. It just gets ridiculous. So you'd obviously have to exclude those. And a building on top of vacant land. So if you have vacant land and you then try to do a borrowing arrangement to put a building on top, then that doesn't work either, because you can't have the land and building separate. It needs to be a single asset. Now I mentioned before about the repairs and maintenance side of things. Once again, 2012 R1, 2012-1. That goes into some very good examples about what the tax office deem as repair or maintenance and what they deem as improvements. So essentially, borrowed monies can be used to repair and maintain a property. It doesn't have to be at the time of acquisition, it can be any time later on. And the tax office deem maintaining a property as preventing defects, damage or deterioration, and the anticipation of future defects provided ensures that the functional efficiency of the asset is maintained. The tax office used this notion of functional efficiency. So in other words, if you have a property that is of a particular function, say a 4-bedroom house, then if you change that functional efficiency, then you have problems. So that's when it becomes more than repairs or maintenance, it becomes an improvement. So if you were to buy a 3-bedroom house that needed renovating and you used borrowed monies to do that renovation, then you would have a problem. If you use the super fund's cash balance to do that renovations, depending on what those renovations were, you would probably be okay. So once again, it's very much about just double checking the finite details of what the client is doing, educating them so they're aware that they need to talk to you or to an advisor about the details if they undertake any improvements or repairs. That ruling then goes on to talk about repairing, so essentially just making good defects, damage or deterioration. They can be acquired, you can acquire a property that does need repair, once again, so long as it's then used to repair it to a normal level of functional efficiency, so you're not sort of going over the top too much. Now the interesting point is, and this is where the really grey line comes in, is the improvement versus repairing. So if the functional efficiency of the property is increased or the value is substantially increased, the tax office deemed that as an improvement. To do any sort of improvements, you can't use borrowed monies. So this is why it's very important to understand that distinction. So the self-managed super fund can use its current cash so long as the improvements did not result in the asset becoming a different type of asset. So if you bought a 3-bedroom house and you put another room on it, that's not really a different type of asset. It's still a house. Granted, now it's a 4-bedroom house, but you have an improvement, so you'd have to use the cash reserves. If you bought a 3-bedroom house, demolished it and built up a 10-storey unit, well, obviously that's a very different asset. So then you have a breach of the SIS Act under 67B. So if the character changes of the asset fundamentally, then it's a different asset. Non-geared unit trusts. Now I've spoken a little bit about these, so we'll talk a bit more about the detail of them if you like. So a non-geared unit trust is actually, they've been around since 1999. For any of you that are old enough to remember, back in the 23rd of August 1999, unit trusts were essentially banned from being acquired. New units were not allowed to be acquired by self-managed super funds in a unit trust that was geared. So they changed the notion of the assets that a super fund could acquire. And they had 10-year transition rules and all sorts of things in there. At that time, they introduced this notion of a non-geared unit trust, which essentially says that a super fund can acquire units in a non-geared unit trust so long as it ticks off a certain criteria. So the way that this works is you look at the in-house asset provisions, and under the in-house asset provisions, the last point there is that any item that's specified in the regulations as being exempt. So you listed shares, business real property, and any items according to the regulations. So then you look at the regulations, and at 1322C you will find this notion of the non-geared unit trust. So it's excluded from the in-house asset provisions. So that means that a super fund can acquire units in the unit trust on establishment, and then later on too, if the trustees so choose. So the example that I used before about the tenants in common scenario, where you have a residential property where the trustees of the fund own 50% and the members personally own 50% of the property, the residential property, and not being able to transfer or the super fund acquire units from the member, by setting up a 1322C trust to acquire the property, the super fund owns 50% of the units, the member owns 50% of the units, and then at any point in time in the future, the super fund can acquire the units off the member. So that's, I suppose, one example of how these things can really be quite powerful. Now there are a couple of, as I mentioned, there's a couple of key criteria that mean that you can use one of these type of trusts in this way. Now, one of them is that the trust must not be used to acquire an asset which has been held or owned by a related party in the previous 3 years. So what they're trying to do there is to avoid situations where you transfer it to your next door neighbour who then sell it to the super fund. Now, there is an exclusion for that for business real property, so long as it's acquired at market value, which, as I mentioned before, always has to be. The trust must not lease assets to related parties of the fund, once again, unless it's business real property. There is an exclusion there for that. Because the idea behind these trusts was to set up an arrangement where the trustees of the super fund can derive some sort of asset protection by having a trust structure there. But what that's meant is that it's opened up a lot more planning opportunities. Now these trusts, they cannot borrow, obviously, because they are called a non-geared unit trust. They must not conduct a business. The trust must conduct all of its transactions on an arm's length basis, and it must not loan or invest monies in any other entity, whether related or not. So what that means is that a super fund cannot acquire units in a unit trust and a non-geared unit trust, which then buys shares or buys managed funds. That's not allowed because the legislation quite specifically says that it cannot invest in any other entity. So even investing in BHP would not be prohibited, would not be allowed. So it's prohibited. On that point about these trusts not being able to borrow, a trap that you may come across is where the bank account goes into overdraft. By just something as simple as that, technically means that the trust has borrowed, which therefore means that it can no longer be a non-geared unit trust. If it's no longer a non-geared unit trust, then it essentially becomes an in-house asset. So the trustees have 12 months in which to rectify the breach. And more than likely, as of 1 July 2014, they'll also be hit with a penalty, administrative penalty, because that legislation has been introduced into the lower house today. A couple of other criteria, or one other criteria I should say, is that the assets of the trust must not be charged for any purpose. So what that means is you can't use the property as security for a loan to an individual or to a related party. It has to be no encumbrances, no loans. Now I've also put there that non-geared unit trusts are a very good mechanism to circumnavigate the collectibles provisions, because the collectible provisions that apply to the super fund apply just to the super fund, not to any related, not to a related investment. So the investment of the super fund is the units in the unit trust, and then that there acquires the collectibles. So you don't have to comply with all of the requirements of the collectibles regime. So having it separately insured, having it stored separately, having it documented that why you purchased the asset, having it minuted, having it insured within 7 days, things like that. So it's a very good way to get around that if you have a real bent for collectibles. But obviously we're talking about property here. So the advantages of a non-geared unit trust. You can reinvest the units. So you physically don't have to flow cash out because the super fund can acquire more units. Acquisition of a greater interest from the other unit holders, as I've mentioned, and that flexibility angle. These trusts are very flexible. They are very used well. They can be used very well. Now, as far as the disadvantages goes, they are restrictive because you can't invest in shares and do other bits and pieces. And negative bank account can cause the trust to be deemed an in-house asset, as I've already mentioned, which is more than a small problem. So essentially the way that this structure works is you have your self-managed super fund which invests in units, and then the unit trust itself goes out to buy the property. And in the diagram, or the structure diagram that I've got there, I have 2 parties involved. You could have 15 parties involved if you really wanted to, because there's no limits or requirements as to the unit holders. They can be all related or family. You can have family trusts, individuals, whatever. It makes absolutely no difference. The other one I'll touch on is a structure that doesn't get used a great deal, mainly because of the complexity that can be involved. But I certainly have done a couple of these, and that's where you have a limited recourse borrowing arrangement being used to acquire units in a non-geared unit trust. So essentially, you're using 2 provisions in conjunction with each other. So the limited recourse borrowing arrangement and the non-geared units. Now, this arrangement is a fantastic way to get around the replacement asset issues of a limited recourse borrowing arrangement. So you probably recall that we spoke about if you had that block of land with a house, a 3-bedroom house on it, you demolish the house, then you put up the 10-storey block of flats, you've got a problem if you used any borrowed monies. By using the borrowed monies not to acquire the property, but to acquire units in the unit trust, and then the unit trust acquires the property, those replacement asset issues are not an issue. There's no restrictions there. So the trustees of the unit trust are well within their right to buy the 3-bedroom property, demolish the house, and build their 10-storey units. So that all works really well. The downside is that the property cannot be used as security for the loan. It's a very rare occurrence where a bank will actually lend money to a super fund to acquire units in a unit trust that then goes on to acquire the property. So essentially, the easiest way to do it is that the members or trustees acquires the money personally using their existing assets as security. Then they lend that money into the super fund to acquire the units in the unit trust, so the unit trust can then go and buy the property. And as I've mentioned there, you've just got to watch out for the carrying on of business provisions, particularly for property development inside non-geared unit trusts. I think at the very least you would want to collapse the unit trust after every project, not that dissimilar to what property developers do anyway, and then start up another trust and go forward from there if that's what they really wanted to do. So how does that look on a bit of a structure diagram? So you have the self-managed super fund with a lender. Now I've got their banks or other relateds. Now typically my experience has been that only related parties will lend to a super fund to acquire units in a non-geared unit trust. So you'll have the situation where the super fund may acquire some units using its cash balance, although it doesn't have to, but it may do. And then the super fund, by the money that it's borrowed, will acquire a majority of the units in the unit trust, which means that the single acquirable asset that the super fund is buying under the loan arrangement is actually the units in the unit trust. Now this then brings another little thing, another little trap if you like to be wary of, in that the units in the unit trust, if you only do one bare trust arrangement, then all of the units are bought together, so therefore they all have to be sold together. They're treated as a collective. So if you have a situation where they might be borrowing a lot of money to acquire units in the unit trust, it may be worthwhile considering breaking those units into different lots. So for argument's sake, let's say you've got $5 million worth of units that you want to issue. Rather than doing $5 million worth of units, it may be worthwhile breaking the loan up into 5 parts. So you might have multiple loans and multiple bare trusts. So you may have 5 bare trusts, let's say, 5 loans, and that way if the super fund ever wants to sell down a portion of its units or the loan, then you can treat it as a segregation rather than have to do the whole lot in one hit. It just, once again, it gives you that flexibility, so it means that you're not locked in to one scenario. So that's how it can look if you just have a single self-managed fund involved in the transaction. Now this looks pretty scary, but it is possible to have multiple lenders, multiple arrangements into a non-geared unit trust, which then acquires the property. I've got one arrangement at the moment where we have 3 super funds and 1 family trust buying a property via a non-geared unit trust. 2 of those super funds are borrowing, 1 is not, and then you also have a family trust involved. Now, in this scenario, all 3 are technically unrelated. Not that that really matters greatly because the trust itself is ungeared. So what you're doing is you're moving the gearing from the trust to the super fund. So running through that, you have super fund 1 that has a bare trust, so it has put in units from the fund and put in units from the bare trust. Then you have the other lender, the other party being the other family trust in this case. Now they may have borrowed money or they may not have, it doesn't really matter because it just acquires the units. It doesn't have to have a bare trust to hold them on a beneficial interest, it just owns them outright. Then we have another self-managed fund that just paid cash for the units, its share, and the third self-managed fund, it also had to borrow. So in this scenario we had 2 funds with 2 borrowings and bare trusts, 1 fund with just cash and a family trust, all investing into the non-geared unit trust. And as I mentioned, it doesn't matter that they were related or not because it's all an exemption to the in-house assets. So then they could then go out and buy their $3 million property that they would have otherwise not been able to fund because of the way that this arrangement works. So hence why this allows for a lot of flexibility and a lot of options, obviously, and it's certainly something that should always be explored with clients. Now, it is expensive to set up, there's no hiding from that, but that's a one-off cost, and if it gives them the ultimate flexibility of what they can achieve, then it's a good result. And finally, the unrelated trusts. Now, there's a little bit of a legal argument, if you like, over these, insofar as typically these unrelated trusts are used where you have 2 super funds, so two parties involved, that also then become directors of the trust or the unrelated trust. Because they only have a 50% interest, the super funds only have a 50% interest in the trust. You have 2 shareholders, having same shareholders, you have 2 directors being the 2 from the super fund, then technically it's not a related party because the legislation says that a related party is if you have more than 50% interest. Well, if you have 50%, it's not more than 50, it is 50. So these do work from a CIS technical point of view. The discussion more revolves around, from a trust law point of view, and obviously a conflict resolution point of view, as to what happens if you actually have 50% each. Because it could very well be in a situation where you can't make decisions and things like that. Now, you have to be very careful if you're suggesting clients do the 50-50 type arrangement, because some constitutions and trust deeds will have powers for the chairman to have casting votes. If that's the case, then what that means is that the trust is a related trust. There was a very interesting ruling recently that while it didn't relate to self-managed super, it has huge implications for self-managed super, because I think it was a daughter and another party were involved in a trust, and the daughter's father was actually deemed to have significant influence and control over the trust. That then meant that he controlled the trust, not the daughter. So in that scenario, you'd have to look at him as well as the daughter, even though she's the one that has the bits of paper. The CIS implication is that for a Part 8 associate, you have to look at who has significant influence and control. Now, that's typically a question of fact, and you won't know as to who has that until you get into it. Control will come down to how many shares or voting rights or units an individuals will have. Significant influence is a completely different beast. It's very subjective, and it's one person's interpretation of it may be different to another. So that's just one thing you really have to look at and focus on quite cautiously if you could recommend these scenarios to clients. But the benefits of having an unrelated trust is that they can actually borrow. So the good old days pre-99 still can exist. The trust can borrow and undertake any prudent investment that the trust deems fit. So there's no issues as far as related party tests or anything like that. It still must be an appropriate investment for the self-managed fund and in accordance with the investment strategy. So the overarching bit of legislation here you need to be mindful of is the sole purpose test, section 62. What was the sole and dominant purpose for entering into that particular investment? Was it to derive a particular tax benefit? Was it to derive a structuring benefit? Or was it for the retirement benefits? The answer is always retirement benefits, hopefully. Now, just to emphasise the point a little bit more, that no one self-managed fund or their Part 8 associates must have control or significant influence of the trust. So what that means is a fixed entitlement to more than 50% of income or capital, that the trust is under no obligation or accustomed to act in accordance with the directions of the members or their Part 8 associates, and I'll talk about Part 8 associates in a tick. And the members and or their Part 8 associates are not able to change the trustee of the trust. So that all comes back to the appointer of the trust. Now, what is a Part 8 associate? A Part 8 associate, it's a spouse of the member, a parent, grandparent, brother, sister, uncle, aunt, nephew or niece. Interestingly, as a little side note, cousins are omitted, so they are okay. They're not a Part 8 associate. A lineal descendant or adopted child of the member, the spouse of any of the above. If you're in a partnership, because partners are more than just a life partner or a spouse, they are actually can also be a business partner. That includes if you own a property jointly, because that is technically a partnership. And any company or trust that controls or significantly influenced the above. So it's quite wide, and before you recommend an unrelated unit trust arrangement, you very much need to map out all of the people who are involved. So look at the shareholders, look at the directors, look at the trust deeds, look at the constitutions to ensure that there's not any significant influence on control or part-out associates that are being involved here. This is obviously can be quite an expensive and exercise to go through, but it's nothing compared to the cost if you get it wrong. So it's well worth it. And basically this is how that can look. So you can have as many funds as you like, obviously, but in this scenario I have 4 owning units in a unit trust. That unit trust then totals off to the bank or related party and borrows some money to then acquire the units. So it means that we don't have to worry about having all the bare trust rigmarole. We can just have the unit trust borrowing the money. So essentially like it used to be in the good old days. Now, I suppose the thing to emphasise why I just have that little structure diagram up is that if say in this scenario here, say that self-managed super fund 1 and 2 were brothers, they would be treated as part-out associates, so they would be clumped together. So their 25% ownership each, in fact, is treated as if it is a 50% ownership. So that's why it's important to really go through that whole structure. If you had 2 brothers and a sister in there, and then an independent third party, then they're all lumped together, so that you've got 75%, so now you have significant influence and control, and it is no longer an unrelated trust. The unit trust is deemed an in-house asset, so you have big problems. So hence why I sort of say it's well worth the exercise in running through, particularly given the list of who is actually in a Part 8 associate or who is considered to be a Part 8 associate. As I said, go the cousin. So that's what the Part 8 associate requirements are, and how you can use an unrelated unit trust as a potential option as well. So, unless there are any questions, I've covered off obviously a fair bit of detail there at a high level, and if you want to know anything further or more detailed about those particular types of structures, by all means, contact me. I've helped many clients involved with self-managed super funds and looking at their structuring, just to, I suppose, give them that more high-level technical advice, just in case something pops out of the woodwork that they might not have otherwise sort of been aware to. And if there's nothing else, I'll just remind you of the VIN Link services that we offer, our membership as part of the VIN Link network, and reminding you also that there is any query is the first 15 minutes is complimentary, and we're more than happy to have a chat to you about whatever scenario sort of you may have, and to help you out wherever we can. So it doesn't look like there's any questions, so I'll leave it there, but by all means, if you want to contact me, please do so. And we will be sending out copies of the slides, so you can have those for your reference as well. So if there's something else, have a great day. Thank you.